Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Abhilash and welcome to Cut to the Chase. It was a volatile and broadly risk-off day for the markets yesterday. S&P 500 declined by 1.2%, while Euro Stoxx index was down 0.8%. In the bond markets, 10-year US Treasury yields declined by nearly 10 basis points intraday before rising sharply towards the end of US trading session to end the day broadly unchanged. Today, I plan to talk about three things: the US earnings season, the upcoming Fed meeting, and the recent geopolitical developments. Let us start with the US earnings season. This week is a particularly important one for the stock markets, as around 175 companies out of the 500 in S&P 500 index, including some of the technology sector heavyweights, are scheduled to report earnings this week. That being said, I would characterize the earnings season up till now as mixed at best. As per Bloomberg, around 150 companies have reported earnings till now, of which nearly 70% have beaten expectations. Overall, this is slightly above the long-term average of 66% beats in the prior earnings seasons. However, we have seen some big misses as well. Just overnight, Walmart, which is one of the biggest employers in US, announced subdued results as well as future guidance. At the start of this week, the earnings surprise for the current quarter stood at plus 5%, but at present, that is standing at around minus 4.9%, which is around 10% swing in a space of just 2 or 3 days. However, if we are looking for a silver lining, the technology sector heavyweights who reported overnight reported relatively resilient earnings as well as future guidance going forward. Given the uncertainty around earnings outlook due to growth slowdown, we continue to favor the defensive healthcare sector in US, which has historically reported a lot more stable earnings compared to the broader market. From the technical perspective, S&P 500 sits at 39.21, which is just a whisker away from the 50-day moving average of 39.19. On the economic data front, US Conference Board consumer confidence reading dropped to a 1.5-year low in July amid persistent worries around inflation and increasing interest rates. According to a Reuters report, consumers are sharply reassessing their spending plans this month, including purchases of major appliances. The low readings from both Conference Board as well as Michigan Consumer Confidence Survey point towards a potentially weaker demand in Q3. However, the weaker economic data we've seen recently is unlikely to shift the Fed's decision around rate hikes tonight, and markets continue to price a nearly 75 basis point rate hike tonight. However, markets are likely to pay a very close attention to Fed Chair Powell in the press conference after the rate hike decision to get a better sense of the Fed thought process going forward. On the geopolitical front, we've seen two major developments in the past 24 hours or so. On the positive front, media reports indicate that US President Biden and Chinese President Xi Jinping are likely to speak tomorrow amidst fresh tensions over Taiwan. Now, this will be the first conversation between the two presidents since March, and it's a very welcome step given the recent increase in tensions. US President Biden has reportedly considered reducing or even scrapping tariffs for some of the Chinese exports, which could not only help lower US inflation, but also at the margin help boost Chinese exports and the recovery in second half of this year. That being said, in Europe, geopolitics have taken a negative turn as Russia announced that it would reduce the gas supply through Nord Stream 1 pipeline to a minimum of around 20%. The recent interruptions to gas supplies cast a cloud of concern over the near-term energy supplies in Europe, which could end up hurting GDP growth over the coming quarters. In line with the near-term negative view on the euro that I shared in yesterday's podcast, the euro fell to 1.01, and in the near term, we continue to believe that we are likely to see selling pressure on any rallies in the euro towards 1.035. That's all from me for today. As always, if you enjoyed the podcast, please don't forget to rate and like it. Thank you for listening and wish you a very happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.